Bonds, fixed income. What is it really, to answer your last question? And what I do every day is I lend money to people. So you can go and put your cash in a bank account and you earn about 5%, 5.5%. My job is to sit at the desk and say, well, instead of lending it to just putting in a bank account, I lend money to Vodacom, I lend money to MTN, I might lend money to Anglo American. And by making these loans, I can earn more interest for you over time than the 5%. So instead, I'll show you later, we're earning about 8.5% on your money. What is important though is once these loans have been made, they trade like shares. So I can take the loans in our portfolio, I can go to another portfolio manager and sell our loans to him. And there's actually a big market, it's actually bigger than the equity market, of loans that get traded between portfolio managers every day. So my job is to manage the market prices of the portfolio, obviously, but at the same time, obviously, to also understand who I'm loaning money to. So I've got the tough job today of actually making loans sound exciting, of making bonds sound exciting. And why do I get excited about this asset class? And the way I'm going to do that is to start off with another interesting and quite exciting gentleman, Charles Dickens. And a lot has changed since Charles's day, particularly how one dresses. But the main thing I want to quote is one of his quotes from how he described the Industrial Revolution. It was the best of times, it was the worst of times, it was the age of wisdom, and it was the age of foolishness. And this applies to investing today. It is the best of times. We have been through 5 years of great performance. Asset classes have all performed very well. People have made a lot of money. It is the worst of times because I don't feel particularly rich, having come through some of the best economic times, the best financial markets. And I ask myself, what's going on here? And the truth is, assets have gone up tremendously, but you don't feel it as much as you maybe have in other cycles. It was the age of wisdom. Now, this is interesting because in today's world, people who are investing, everything has gone up. So to be a genius at investing, all you had to do was buy a financial asset, and whoever bought the most risk was the biggest genius. And you get a lot of, as we were talking earlier about news on MoneyWeb, you get articles written by people. And when you dig deeper, sometimes, it's interesting to see how defendable some of the views are that you see. And it's the age of foolishness because you start hearing a lot of foolish talk and, you should do this, that. I see a lot of very interesting companies starting to list on the market. We call them top of the market companies, because it's right at the end of the cycle. You tend to have a listing boom of people coming on, just to monetize some positions. But it's very, very good description where we're at. So in terms of fixed income, talking about the age of foolishness and what people talk about, one of the biggest things I hear at the moment is interest rates are going up. You are going to lose your shirt in bonds. You are going to lose everything. I saw on Bloomberg $2 trillion lost off the market on bonds. I read about how interest rates are going to halve the value of bonds. So I just want to deal with that for a minute and say we manage money for Optimum. We're very cautious in how we do that. And let's talk about how the portfolio is positioned. Then I'm going to talk about some bonds and some of the opportunities that actually exist in rising interest rate environments. So if you go to a fact sheet of a fixed income fund, what you should find is two items of information. Normally, as asset managers, we will disclose a thing called a duration or modified duration, and we will disclose a portfolio yield. That's what we're telling our clients on our fact sheets. The question is, what does that actually mean? What should you take away from that? And I'm going to talk to you through an example so you can see what actually happens. And in our first example, what I'm saying is let's assume interest rates stay exactly constant, so nothing changes. What is going to happen as a fixed income manager? Well, scenario one, rates remain constant. In a world where interest rates don't change, there is no capital gain or loss on the portfolio. So your portfolio value today is the same as your portfolio value in a year's time. So you buy a share and the share price does nothing. That's what will happen to fixed income. But we earn interest income over the year. And our portfolio yield was 8.3%. So we earn 8.3% on your money. 1 year's time, what have you got in the bank? You've got an 8.3% return on the portfolio, which is about what we've done actually on the Optimum portfolios over the last year. Let's say interest rates go up. Is that bad for the portfolio? Well, if interest rates go up by 2%, what happens? The 2% that interest rates go up times the modified duration of 0.6, and this is sort of bond math. I'm not going to try and make bond math exciting. It just can't happen. But bond math quite simply says 2% times 0.6 is 1.2%. The portfolio, if interest rates go up by 2% tomorrow, the portfolio will lose 1.2% on the portion we manage. But here's the interesting thing. The interest rates have gone up, so now the interest we earn isn't 8.3% anymore, it's 2% higher. We're earning 10.3%. So what does that mean? That means that you make a capital loss today, your interest income actually goes up, and at the end of the year, you've actually made more money from a rising rate environment in the funds we manage for Optimum. So this is how we are positioned today on the portfolio that we are managing, is our view, come back to Lawrence's previous question, interest rates are probably going to go up. Eskom tariffs, they are increasing those. We're seeing a weak rand right now. We are seeing a lot of talk of America raising interest rates. What does that mean? That means towards the end of this year, our expectation is that the South African interest rates will be hiked again. That means the mortgages will cost more, but it means that the portfolio that you're invested in, hopefully, will actually start to yield even greater income for you over time. So that's very much how we position. Actually, come back to what you typically see in the press about how you're going to lose a lot of money when interest rates go up. Not happening here. The next interesting example I used was a real-life example. I was sitting at my desk, it was about 3 weeks ago, and Rowena, who's one of the brokers, phones up and says they have some ABO11 bonds, and that's why fixed income is such a terrible asset class, because nobody stands at a bar and talks about an ABO11. But they had some ABO11s that they were looking to sell. It took us about 1 second, and we said, absolutely, we'll buy those bonds. And we've actually put them into the Optimum portfolio that we manage. Why did we do this? Conventional wisdom is, as interest rates go up, bond prices go down. So let's look at the ABO11. Compliance says I'm not allowed to do my own math and stick it in a spreadsheet. They get cross with me. So I had to go to my friends at Avior and ask them to actually do the math for me, but it's the same math as we did when we bought the bond. First thing I asked Avior to do was, tell me what the price is of that bond today at today's interest rates. And the price of the bond is 99 Rand 17. It's like buying a share. I buy the share at 99.17, and I earn on this particular bond about 10% interest income. So we're getting out 10% every year paid to us, and we paid 99 Rand for the bond. I then said to Avior, do me a favor, value the same bond, but change one assumption. Assume interest rates go up by that same 2%. What happens is the bond price actually goes up to 99.54. So here's a bond that we found on the bond exchange. We actually bought it for the portfolios that we manage on your behalf, which will appreciate as interest rates go up. If you think about it just as a normal investor, what does that mean? It means I buy the bond today, I earn 10%. If interest rates go up by 2%, I'm now earning 12% income, and I've got a capital gain. I mean, that's the absolute perfect asset for a rising interest rate environment. So very much that's why we snapped up some of these bonds for our portfolios across the board. Very, very important. We didn't snap up too many of the bonds. It is still less than about 2% of the portfolio of Optimum, and probably less than 2% across the board for us. Why? Because absolutely we believe in diversification. I'm supposed to stand here today, and my topic was to talk about risk and rewarded risk and unrewarded risk. Interest rates rising, don't worry me. We're very well positioned for that. Our portfolios will perform particularly well. What does worry us are the unforeseen things. This bond was issued by ABSA, so we've actually lent the money to ABSA. But, could ABSA sneeze? Could there be a surprise at ABSA? We've seen it at African Bank. My job is to make sure that we are defensive for every possible unexpected event, however unlikely it is. I mean, if 3 years ago you'd said African Bank would go the way it did, nobody would have believed you. They'd probably laughed. You'd have laughed me off this podium. Instead, random things do happen, and it's about being well positioned, very diversified for those random events. That is very important to us. So here's where I'm going to differ a little bit from Pierre. And we talk about opportunity, and what I managed to find was a bond that appreciated as interest rates go up. Now the truth is these are incredibly rare in South Africa. There are probably 3 or 4 of them that are listed on the bond exchange, so it is very unusual. But now the difference, or the important thing to realize, is that South Africa is a tiny, tiny fraction of the bond market. So if you are playing in domestic fixed income, that is the market cap, that is the size of your opportunity set, and you are missing out on all of that. Can I find bonds that will appreciate in value as interest rates go up in the rest of the world? I can find you thousands. I've traded and managed thousands of them. The problem is in South Africa, there are probably only about 3. So that is why we do prefer to see some offshore investment in our portfolios. It gives you that ability to access interesting positions, unusual positions, gives you that diversification. The other comment I'd make, and it goes back to Pierre's comments earlier of, why would you buy a bond in America? Interest rates are 1.5%, 2%, 2.2 today. Why would I do this? Well, if I go in South Africa and I buy just a government bond, so I lend money effectively to the government, effectively you're lending your money to Jacob Zuma, I'm earning 8.2% on a loan to Jacob Zuma. So I go to America, or actually again compliance said I can't do the math, so I had to go to Goldman Sachs to get the math done. But I go to Goldman Sachs, I say, buy me a bond in America. I don't want to lend money to Jacob Zuma, I want to lend it to Barack Obama. So I lend money to Barack Obama at 2% in dollars. I then say to Goldman Sachs, or any other bank actually, I usually use Standard Bank, please can you hedge my interest rate risk and my currency risk, because I don't want to sit with a lot of currency risk. It's, I can't tell you where the rand's going tomorrow, I have no idea. I put on that hedge, but now what they will do is they will pay me to hedge that position, because what I'm effectively doing is selling dollars and buying rands, and the banks will pay you quite a lot of money to do that. If I add all of that together, which is now where the technical expertise come in, I'm not going to do bond math, what you will find is I can lend money to Barack Obama at 8.5%. So as a bond manager, my job is to now sit and say, well, who's the better credit, Barack Obama or Jacob Zuma? Who do I want to lend money to? The rating agencies all rate America higher than South Africa, so I can actually get a better credit quality for my investor offshore than I can domestically, and I earn more money. If I'm really smart, what I can then do is go to the American inflation-linked bonds, buy one of those, put on a few extra hedges. I can create a bond that looks and behaves exactly like the South African bond, so it's going to behave the same way, with one big difference. Instead of lending money to Jacob Zuma at 8.17, I'm now lending money to Barack Obama at 10% for the portfolios. So that's why you want offshore exposure. You can actually, if you're smart about how you take it, if you structure it, you can get much better credit, but at the same time, I'm earning 2% more for my investor. That's what fixed income is about. Those are the subtle skills that actually, push the portfolio's returns up, while still obviously managing risk. So in summary, what is Efficient Select about? And our vision is to significantly enhance the financial well-being of investors. Firstly, we do that by managing the funds that we are actually allocated very, very carefully, very studiously, but also with the clear objective of providing returns in line with investor expectation. The second aspect of it is sharing knowledge, talking to people, and that's obviously what I'm doing here. So in summary, to pull it together, fixed income, and hopefully I've made it a little bit more exciting than it could have been. Playing in the smaller markets in South Africa, you get an okay return, but there's a lot that can be done in the offshore markets as well. Offshore bonds are very attractive at the moment. The ability to get that extra 2% return, lending money to offshore, that's probably some of the best opportunity I've seen. Usually it's far less than that. So, these are the times that we are looking at those types of structures. We do actually have some of those in the portfolio as well. And then finally, fixed income can actually be very attractive through the rate hiking cycle. It is not a case of just run away from fixed income and put your money under the mattress. The stable fund, which I'm a part of, actually, it should produce very attractive returns, and even more so through a rate hiking cycle. So from that point of view, we feel that we're giving you the best opportunity and the best probabilities of achieving your long-term investment objectives. Thank you.